Good morning. Welcome to Finance Investment by Ms. Trinh Nguyen, CFA Charter Holder and Master of Economics in Banking and Finance. After series on real estate stocks, today our discussion is about personal finance and investment. You are at any age, you are young, you are retired, or you make any job, like you are teacher at school, you are entrepreneur, you have startup, or you will find this video useful to manage your money and financial life. You find that my YouTube is full for successful investment to become richer and less time and efforts. My YouTube provides necessary knowledge, skills in difficult aspects like macroeconomy, real estate, stock market, finance, investment consulting. The contents of today's discussion include benefits of this video, personal financial profile, traditional and behavioral finance, then the content about investment plan, like return requirements, risk objectives, liquidity, and time horizon. Final content about comparison between human and financial capital. Benefits of this video. You can have early finance investment planning, which brings security and comfort when you're old or you're retired. You still afford to buy good items that make you happy. You have also investment income, which helps to bring more money to spend, to enjoy and save or invest. You not just depend on salaries or your business because you have more financial flexibility. You are younger, there are more investment options and higher return, plus more ability to take risks to invest in assets with stronger returns. You can arrange finance investment plans that is suitable for you in terms of age, personalities, asset size, ability, and willingness to take risks. About financial profile includes sources of wealth and stage of life. Sources of wealth include active wealth creation and passive wealth creation. Active wealth creation, like you are entrepreneur, you are self-made investor, then your willingness to take risk is above average. About passive wealth creation, you have skill work with assets accumulated over a long period. And also you can receive unexpectedly income like inheritance, bonus, winning lottery. Then your willingness to take risk is below average. Wealth maintenance and protection is important to maximize long-term returns. You should have disciplined strategies in personal finance life, investment, borrowing, spending. Stages of life include 4 stages: foundation, accumulation, maintenance, and distribution. In the stage of foundation, you establish base of wealth from your marketable skills and knowledge, from your education certificates and degrees, or your business and startup. Normally, you are young, like at 20 years old. You have low-risk investable assets with financial uncertainties. However, positive point, you have long-term investment horizon with high risk toleration. In accumulation stage, like you are in 30, 40 years old, then you have higher income and accumulate investable assets. In addition, expenses are also rising. Family costs like house, children education. Your risk tolerance increase and your investment horizon remain long. In the maintenance stage, you retire with desired lifestyle and financial security. In this stage, wealth preserving is more relatively important than wealth growth. You have lower risk tolerance and investment horizon is shorter. In the distribution stage is the stage that it transfer accumulated wealth. You should consider various transfer strategies if you are rich. And substantial wealth needs well-planned distribution projection, like inheritance, like divest of own stocks. A comparison between traditional finance and behavioral finance. Characteristic of traditional finance is in theory, it's about what rational investors should behave and it's assumed the market is efficient. While in behavioral finance, it's in practice, why normal investors behave and market is inefficient. Investors in traditional finance is risk aversion. For example, among investment with the same return, Risk-averse investors choose the investment with lowest risk. Investors also have rational expectation and asset integration. In behavioral finance, people are loss aversion. That explain why they hold losing portfolio for a long time, because they are afraid of loss. Investors have a bias expectation and asset segregation. Assumptions in traditional finance, asset pricing is driven by economic and fundamental factors. For example, stock price influenced by earnings growth of company, by profit margin, and the leverage, the capital structure of the companies. However, in behavioral finance, asset pricing also impacted by individual personality, like fear, like taste. In traditional finance, portfolio is constructed with diversification of multi-assets with considerations of return, risk, and correlation among assets. While in behavioral finance, portfolio is constructed like a pyramid, layer by layer of assets. Traditional finance investment portfolio includes various assets to benefit from diversification. That means lower volatility. For example, in the portfolio, if you are young, you can allocate 10% to banking deposit, 20% to government bonds, 30% to stock, 30% to real estate, and 10% to gold. So in traditional finance, there is formula for you to calculate this way, so you can have optimal portfolio with lower risk. However, in behavioral finance, it's a pyramid portfolio. It's a combination of risk assets like banking deposits, government bonds, and then less risky assets like real estate, stocks, corporate bonds, and finally, the layer of highly risk assets like derivatives. You should have investment plan. So investment plan includes return, risk, liquidity, and time horizon. Investment plan plays an important role because it sets financial objectives. It defines degree of risk. It also considers need of liquidity. Liquidity means ease of investment asset convertible into cash. There are also the timeline investment, long term or short term or middle term, with one stage or multi-stages. Also, portfolio monitor and review. For example, you construct investment plan for your portfolio when you are 20. Then when you are 30, you get married, your chance of life, so your portfolio should be monitored and reviewed. The first content of investment plan is return requirements. The basis of return requirements is annual spending and long-term saving goals. There are two returns, required returns and desired returns. Required returns are must, like living expenses, food, clothes, housing, rent, or college education. You can buy a house and children care. Desired returns are which, like vacation home and luxuries. So you can have annual spending and saving. Annual spending is from your portfolio's income, like dividend interest. When you invest in stock, you have dividend. You invest in bonds, you have coupon. So this income of the portfolio serves the annual spending needs. Saving goals from growth, like capital gain or price appreciation. For example, stock price increase, so you have saving goals. Income-oriented targets tend to take lower risk with allocation more to bonds. While you are young, you have less demand for income, so your portfolio is grow more towards equities, towards stocks. Returns are defined in real terms after adjustment for inflation. For example, returns are 7% per year and plus inflation 4%, then the real return is 7% and nominal returns are 11%. These objectives, the basis is ability to take risk and willingness to take risk. Ability to take risk is objective. It depends on financial goals and asset resources. Spending needs are relative to asset size. For example, your asset is 1 million USD and you have spending needs every month just 2,000 to 3,000 per month. So spending needs is relatively low to asset size. And time horizon, longer term, you can invest in higher risk assets. you have higher risk ability. About willingness to take risks is subjective and it depends on taste, job, personalities. For example, you are a teacher, your office staffs, you have secure jobs, so your willingness to take risks is under average. While if you are entrepreneur, you have startup, your willingness to take risks is above average. Liquidity, the basis is spending needs and liquidity characteristics of asset portfolio. Spending needs include normal and recurring expenses like living, childcare, as I mentioned. You also need sufficient surplus for emergency needs. It normally in range of 3 to 12 months of recurring expenses. Besides, you can have major planned events like travel, new home. So liquidity of asset portfolio is necessary so to cover these spending needs. You should consider in the portfolio like transaction costs, like volatility of asset pricing. For example, the stock price is volatile. So when you need cash, should be the time that the asset is a high level of pricing. And also consider illiquid asset like real estate. If you have a long-term horizon investment, like 2 or 3 years, your portfolio can include real estate. Time horizon of investment plan can be short-term, less than 3 years, long-term at least 15 years, and mid-term from 3 to 15 years. It can be single or multi-stage. Single stage, like all persons with limited financial resources. However, it normally is multi-stage, including pre-retirement, retirement, and post-retirement stages. Time horizon is important in setting return objectives and liquidity. Comparison of human capital and financial capital. Human capital is lifetime earning capacity, including salaries, wages, bonuses, pension. You can see in the chart, when you get older, your human capital decrease. And when you retire, human capital is very low. Financial capital is income from investment. Like over 10 years of investment stock, your financial capital grow. Human capital, there are 2 types of human capital, stock line and bond line. Stock line human capital relates more to economic cycle and equity returns. For example, you work in financial industry, work in banks, in securities company, in real estate companies, or you're entrepreneur, you have startup, so you have stock line human capital. Then you should invest more in safer assets like bonds. However, bond like human capital, like you have safer job, you are teachers, you are office staff, so you should invest more in stocks. The risk in human capital is earning risk. When you get unemployed, you don't have money earnings, so you should have investment to offset that. Longevity risk, that you live longer than expected, so you should have a pension to offset this risk. Now I am discussing here. This video helps you understand about the role of financial and investment in personal life. You can apply to your life and get richer at early time and less efforts. Please click on the subscription under my video screen so I have more motivation to make interesting, high quality videos in coming time. Thank you.